For more on this, I'm joined by Jim Stening, who joins me in studio from FIIG Securities. Jim, thanks for your time again today. An explosion of interest, I suppose, even in the last 48 hours or so in the sovereign crisis, as some people are calling it, in Europe at the moment. What's your assessment of how much this is actually going to weigh on the RBA's mind as it looks at the globe and looks at the local situation to decide on interest rates next week?
Yeah, interesting. I mean, it's an unfolding story, obviously. I think, importantly, the Reserve Bank is not solely focused on what's happening offshore. I think that, interestingly, if you look at the result of the recent inflation figures, if we hadn't have seen a small increase there, perhaps that the events in Europe would have meant that they'd back away from a tightening. But I think realistically, you know, the comments from Guy Debelle indicate that they're not putting too much weight on the Greece crisis as it currently stands. And I think also it's important.
Well, he said that the cost of borrowing for Australia has not changed.
That's
basically.
right. I think if you look at indicators such as our credit index, you know, I think these are things that reflect the market, what the market actually considers to be the impact on borrowing rates for corporates, including the banks, and we've certainly seen a pop up in that index, but it's nowhere near crisis levels. It's certainly very manageable, and some would argue, you know, not material.
Right. So sentiment-wise for the markets, okay, important in the short term, but the actual impact here, you don't see any.
Well, look, it's not that I don't see any, but I think that when you look at the Australian situation in isolation, and some might say it's dangerous to do so, but it's a very rosy picture in Australia. I mean, if you look at sovereign debt, if you look at debt levels in Australia, they're meaningless compared to these other economies. And then if you look at growth is well and truly on the up and up, and in fact the IMF have said that Australia will lead the charge there. So it's a very different scenario, and to say that you know, an excessive portion of weight should be given to what's unfolding in Greece, to the RBA's decision, has to be balanced with the domestic situation. And what we got yesterday was an indication that inflation is a little bit higher than expected, and that I would say would alarm the Reserve Bank.
Well, enough to give it kind of. Do you think that was even the smoking gun for the rate hike next week?
I think so. I mean, from our perspective, we think it will happen, and I think you know, looking at global equity indices, looking at credit indices, yes, there's been a blip, but I think that the markets are indicating that they think that this Greek situation in isolation will be solved.
The concern for the market, I suppose, is that when you look at the toing and froing of all the political leaders in Europe, I mean, the concern is that politics is really taking precedence over the actual economic crisis.
That's exactly right, and one of the things that we have to bear in mind is that these things, and look, Greece is an extreme, and it's a very very complex and concerning event. But we are going to be, we are over the next 6 to 12 months, we are going to see downgrades. We are going to see more sovereign issuers put on negative watch. I guess, you know, looking at where this might lead, given the S&P's activities again overnight. I mean, the focus turns to the UK. AAA rated issuer on negative watch. You know, are we likely to see a downgrade there? So these are things, I think we've referred to it before as the death of 1,000 cuts, that we're going to continue to see. One thing, it is very important. It's important that these issuers are seen to be addressing it, and we saw in the US during the week that Obama has set up a national committee to develop a strategy to deal with the reduction of debt over time. The co-chair is Ben Bernanke. It's both sides of Congress involved in that panel. So that's constructive, but it also highlights that this is an area that needs to be focused on now.
If we recognise that the impact on sentiment, though, isn't the issues, you know, you've just mentioned what happens if the UK has a credit downgrade. Sentiment then can just feed back, and it's kind of that negative feedback loop. And that's you know, how realistic is that concern? Well,
I suppose it's you know, it is realistic. It has to be factored in. But I suppose if you're looking at, again, Australia in isolation, we do seem to, there is perhaps some you know, some weight, some relevance to the fact that where we're located geographically and what we export. Okay, so
firmly focused on really the domestic situation for the RBA and the mandate, which is inflation. You mentioned that. We've had the figures yesterday.
That's right. That's right. I think you know, if in fact this crisis in Europe in the sovereign issuers does lead to a global crisis and a banking crisis, and that's I suppose hopefully a low probability, well then the Reserve Bank will most definitely have to adjust monetary policy quickly down, I'd imagine. But in the interim, I think that they need to address this emerging inflation problem.
Have you got any thoughts as well on the financial reform in the United States and what's proposed there? Because I suppose for the markets again and for us, the concern is that commodities end up being affected. If they put a lid on all these activities of these big financial players in the market, you know, maybe less money goes into commodities, that keeps a lid on things. You know, how are you kind of reading that issue for us at the moment as kind of a flow-on effect?
Well, look, I don't really feel like I'm in a position to be able to comment on that. I think that regulation in general is probably a necessary thing, something that you know, obviously markets, with the benefit of hindsight, were out of control. So the implementation of some controls is a good thing. I think they're obviously, in the States in particular, they're having difficulty agreeing on what is appropriate.
Can I ask you as well about a couple of key upcoming events, one being obviously Henry Review this Sunday, but then of course leading into the budget, which will be May 11. What are you actually looking out for?
Well, I mean, I think the Henry Review, again, you know, we've talked about you know, friendly tax rates on interest rate products, or specifically deposits. You know, I think that's probably in terms of our asset class, you know, what would be a good thing. I think in terms of the budget, I think we can expect to see you know, a significant reduction in the requirement to issue debt from the Commonwealth Government. So I think that's a really positive thing. You know, with growth estimates being revised up and receipts being higher than expected, I think that they'll be in a you know, very good position to be able to you know, to demonstrate a reduction of debt or faster than previously expected.
What kind of level of fiscal restraint would you expect in this budget?
Well, I mean, I think the government, you know, is eager to demonstrate that they can show fiscal restraint, and so I would expect them to deliver that. I think that perhaps the you know, the recovery being larger than expected has put them in a great position to be able to do that. I suppose the overlay is that we are in an election year, and you know, ultimately down the track, if later on this year we're seeing increases from the Reserve Bank again on top of these increases, that could be a difficult scenario for them.
Jim Stening, great to have you in. Thank you very much.
Thanks, Brooke.
Jim Stening's Managing Director of